Sorry about that. I had to stop the video for a second, so let's pick back up. We're on August 20th. We have the meals expense. Okay. Again, we just did the postage. Now we have the meals. This time, again, remember they said on account, so that we didn't pay it yet. So it's an accounts payable because it's owed. Bought lunch on account. And this was for $125. And then on August 22nd, we paid the utility bills. So it's utility expense. And we used cash. So we paid utility bill. Or just paid utilities is fine. And that was for $575. Okay, so again, that's recording the different expenses different ways. Two are paid with cash. The middle one was paid on account. So that did it that way. On August 23rd, we sold equipment to Temple Company for $3,400. They paid cash. So they paid cash on August 23rd. So we know right off the bat, our cash went up, which is an asset. So we know we're going to debit cash $3,400. Now, what did we do to get that cash? We sold them something. We didn't sell them service. We actually sold an equipment. So for that equipment, we're going to call that not service revenue, but we'll call that sales revenue. Because it's equipment that we sold this time. And we'll list that down there, sold equipment. Now, August 29th, we actually received payment from last month. Similar to what we did up here, where we received payment here from our customer on the 8th. We received half a payment. We received this payment last month. It just repeats itself. It's still going to be a debit to cash because cash is coming in. It's a credit to accounts receivable because what they owe us is being eliminated. So we're going to list that there, cash, credit accounts receivable. And it's for $2,100. Got us a new sheet because that one is full. And we have our last transaction for the month. So we'll start it on the new sheet August 31st. We accrued salary. So accrued means you've collected. So why do we accrue something? So we're accruing salaries because, for instance, again, it goes back to record the expenses of the month they take place, even if you don't spend the money. So basically what's happening here is all our employees worked for the month of August, but we have a policy we don't pay them until the first of the next month. So even though we're using the cash on September 1st, the work they performed is in August, we have to record the expense in August. So we look over here and we should see salaries expense, and that's what's happening. We have an expense for salaries of $2,000 for the month. So we're going to list that here. And normally when you have salaries expense, you'd use cash to pay it, but we're not paying them today. We're just accruing the expense today. We're going to pay them on September 1st. So we have to, since we owe it to them, that creates a liability. which we have right there, this salaries payable. It's a payable of salaries, so we're going to list that as our credit. And we're going to accrue salaries for the month. Okay. So that is all of our transactions for August. Now, down beneath you have adjusting entries. So if you looked at the PowerPoint slide and the video we posted, the purpose of adjusting entries is to make those time-sensitive adjustments. We are adjusting for expenses, we're adjusting for revenue earned, we're adjusting for a bunch of different other items. Mainly expenses and revenues are what you're adjusting for. Adjusting entries never involve cash. Cash is never involved in an adjusting entry. Everything takes place without cash. And that's why they're called adjustments, because there's really no trigger. Cash is always a trigger of an account needing to be done. In this case, we're just making adjustments to accounts that already exist. So what we'll do is we'll start a new column here, and we'll just call it here adjusting entries. And you can list all these just like that. You just list them under this column for adjusting entries. It all takes place on August 31st. So we'll put that date there. And the first one we're going to do is do our balance of office supplies. Well, if you recall, I'm looking for it. If you recall, when we did our July transactions, we had an office supply balance of, let's see, what was that amount? I think it was $825, I believe is the amount. I'm looking it up now. Let's see. $820, that is correct. So we had a balance in our office supplies of $820. What the August transaction is telling us is at the end of August, we counted up all our office supplies. We had purchased this amount for $820 in July. And now at the end of August, we have a balance of $425. So somehow this balance we have to get down to $425. The only way we can get that to decrease is to credit some amount. The amount we're going to credit is the difference, which is $395, to get us from $820 to $425. So how do we do that? So we know we have to have a credit to office supplies, and what that is against is its office supplies expense is our debit, because what we are creating is an expense. The expense is the use of the office supplies that we purchased. So we're going to do $395 debit to office supplies expense, and we're going to credit office supplies $395, because now we have to get that balance down to $425. Based on our count of office supplies, that's what we have left. On August 31st, we're going to record 1 month's rent. Same idea. Let's look at the T account. I had prepaid rent here. When we prepaid the rent, we had $4,400. That was for 4 months. 4,400 divided by 4 is 1,100. So we now, from the beginning of the month to the end of the month, we've used $1,100 worth of that rent. So we have to get this amount down to $3,300. The only way we can do that is to credit prepaid rent $1,100. We're going to credit that by creating the rent expense of $1,100. So let's go right here. We have rent expense. And prepaid rent is my credit. And we have 1,100 and 1,100. Now, the next transaction is now dealing with that service contract. Well, let's take a T account look at that. I have unearned revenue of $1,200. And that was for a 60-day contract. That was done on August 1st. At the end of the month, 30 days, half of that contract has been used. We filled our duty by offering them service for the first 30 days of that month. Half of $1,200 is $600, so I'm going to put a debit to that. And the offset of that is now we can count that $600 as revenue. We already got the cash, but now we can actually record the revenue. So we're going to do a debit to unearned revenue to show that we only owe $600 more dollars worth of service on that contract. And we're going to credit service revenue because now the revenue we can earn, we can show that that revenue now exists. Okay, so that's 600, 600. The last piece we have to deal with is the depreciation on the furniture. So if you recall, let's put this over so you don't see the back as good. All right. I should have brought up another blank piece of paper. Here we go. We got the furniture for $25,000. Okay. All plant assets, fixed assets, like furniture and all those other great things, depreciate. They lose value. Okay. So they depreciate. Key things are, this is the purchase value, or in this case, this was the value at time of gift. We gave common stock for that. So indirectly, we purchased it with common stock. We didn't pay cash, we paid common stock. Another key item you would need is residual value. Residual value is an arbitrary number given by the company that basically says, after the useful life of this product, of this asset, it will have this type of value. So they told us in the problem it's got 4 years because we're going to depreciate it over 4 years. So it's got a 4-year useful life. They didn't tell us what the residual value is. So you just assume if they don't tell you, it's 0. So now we got to find out what the monthly depreciation is. The monthly depreciation equals the purchase value minus the residual value divided by the useful life. Now, we were told the useful life is 4 years. We want a monthly amount. So you take 4 times 12 months, or 48 months. So in this case, it'll be 25,000 minus 0 over 48, which if you do the math, it equals $520.83. Okay? So we now want to go over here, and we have depreciation expense. So what's our credit? Well, this is an interesting thing. If we go back to our chart of account rules, you see that furniture is an asset. And when furniture goes down, when an asset goes down, you credit it. However, plant assets, we don't touch the actual asset itself. You never want to credit a plant asset, or a fixed asset in this case, like the furniture, until it's actually sold. Instead, we have this special account called accumulated depreciation. Accumulated depreciation, as you saw in the video, is what they considered a contra asset account. It's an account that goes against an asset. So it's kind of in partner with the furniture. It indirectly is going to depreciate or decrease the value of the furniture without ever crediting furniture. It's just all going to collect in this holding account. So we're going to credit here accumulated depreciation. And we're going to say that that's accumulated depreciation for the furniture. Okay. And that's our credit of $520.83. All right. So that does the whole process of recording the transactions for August. I recommend you go through this a couple times, verify what we have. I'm going to post a Excel spreadsheet showing all these in writing, so you have them also to look at and go against there. So that's going to be up too, so you can look at that. It'll be below where the video is. And then we'll go into the instructions of what is next. Remember, the whole process of accounting is once you journalize the transactions, you have to go through and post them to the T accounts. So similar like we did for prepaid rent on our T account. If you look here, we have prepaid rent, right? Prepaid rent, here's our T account for prepaid rent. We put a debit on $4,400. You go back up to this, prepaid rent, and you put a check mark next to that because you posted it. Okay? You have to go through each T account and post each of these transactions to the T accounts. More instructions will be in the module. Hopefully this helps you get through the transactions, and we'll go there from there. Talk to you soon.